Good morning. This is Muhammad Suleiman, Assistant Professor of Commerce, MVS Government Degree College Autonomous, Mehboob Nagar. Today, let us learn accounting standards. As all of us know, business is an activity taken up for earning profit. There are different forms of businesses. We all know it very well. Sole proprietorship, partnership, and company form of businesses are into existence. When we talk about different type of businesses, company form of business is the important one. As all of us know, company is formed by collecting share capital from various shareholders situated across the globe. Every financial year, the company provides annual reports to its different stakeholders. When we talk about different stakeholders, we can take the example of shareholders, creditors, debtors, government agencies, banks, etc. All these people are interested in knowing the financial performance of a company. Now, it is important to learn that the financial statements provided by a company are prepared by accountants. In the process of preparation of financial statements, it is important that the accountants shall follow certain standard norms, rules, and regulations which aim at bringing true and fair view of the financial position of the company. So, for that purpose, it is important for us to learn accounting standards. Now, let us see the objectives of the lesson. In this lesson, we will know the concept of accounting standard, meaning of accounting standard, definition, need of accounting standards, objectives of accounting standards, various benefits that come on adoption of accounting standards, and different limitations that may come in the process of following the accounting standards. In common parlance, standard is understood as a measure or yardstick used to record something. We measure different things, different substances, different solids, and different forms through one particular measure. In the same way, accounting standard can be understood as a measure or yardstick used to record the transaction in the books of accounts. While recording the transactions in the books of accounts, an accountant is supposed to follow the accounting standard relevant to that particular transaction. Without accounting standard, we cannot expect the transaction made or the transaction entered in the books of accounts to be reliable and qualitative. So, for that purpose, accounting standards have been drafted and accounting standards have been issued by various professional and regulatory bodies and government from time to time. And these accounting standards are applicable on the preparation of financial statements so that the financial statements prepared by a company or by an entity shall provide a true and fair view of the financial position of the company. Now, let us see what is meant by an accounting standard. Different people may have different understanding on the concept of accounting standard, but one meaning of accounting standard that we can see here is accounting standard can be understood as basis as to how the financial information of an entity must be recorded. It will provide a guide, it will provide a direction regarding the method or regarding the way in which a financial transaction shall be recorded by a company. So, different approaches can be there while explaining the meaning of accounting standard, but we can understand in a simple manner that it provides a basis. So, without accounting standard, then the process of recording the financial information may become difficult. Now, having understood the meaning of accounting standard, let us see the definition of accounting standard. Many experts have given definition on accounting standard. One famous definition is given by Kohler. According to him, accounting standards mean a mode of conduct imposed on accountants by custom, law, or professional body. As all of us know, that accountants prepare the financial statements of a company. So professional bodies like Institute of Chartered Accountants of India, where accounting standard board is there in India, will issue from time to time different accounting standards to be followed, and various regulatory bodies like Ministry of Corporate Affairs and other regulatory bodies will see that the accountants follow the accounting standards while preparing the financial statements. Even before the standard is issued for the purpose of adopting while preparing the accounts, the standard setters, say for example the accounting standard board, will issue a draft accounting standard and will take the perceptions, opinions, and feedback from various stakeholders and probable difficulties that may come across after the proposed accounting standard is actually implemented. After taking into consideration the different feedback, suggestions, and perceptions and practical difficulties explained by different stakeholders, the final accounting standard will be issued by the regulatory bodies, which is supposed to be followed by all accountants and the staff who are involved in the process of preparation of accounts. So, in total, we can understand that accounting standards are a set of rules and regulations. Accounting standards are standard rules which are supposed to be followed for recording the transactions and preparation of the financial statements by a company. And one more important point that we have to understand is accounting standards are applicable to all. It does not mean that accounting standards are applicable to only few business houses and are not applicable to some other business houses. It is not like that. Accounting standards are equally applicable to all business houses and which are supposed to be followed by everyone. And one more important point that we have understood here is accounting standards are prepared by professional bodies who have a lot of experience and expertise in the field of accounting. And it is important to note that the accounting standards prepared by the professional body are approved by the concerned government or regulatory authorities. Having known the concept of accounting standard, meaning of accounting standard, and definition of accounting standard, let us move further. Now we have a question. What is the need of implementing accounting standard? Imagine a situation where there was no accounting standard. We know it very clear that the business environment and the activities of one company will differ from another company. The business environment in which a company functions may not be the same in some other country, or the situations may not be the same in some other place. In such a situation, the impact of all such things will be there in the process of preparing of the financial statements. In order to overcome such practical difficulties, in some situations there may be different practices that a company follows for treating and regarding one particular transaction. In such circumstances, it will be difficult to make comparisons, to make judgments, and to assess the true and fair financial position of the company. Hence, in order to overcome such difficulties, it is required or it is needed that there shall be some accounting standards which can bring uniformity and help the comparison process of financial statements. So, for that purpose, the need for accounting standards is stressed by objectivity, uniformity in rules and regulations, and comparison of financial statements. Now let us see one by one. The first and foremost point that gives importance or that provides a reason for need for accounting standards is objectivity. Objectivity is a qualitative phenomenon which is to be followed by accountants while preparing the accounts. By objectivity, we mean treating the transactions in the same manner, reporting as it is. If there is no objectivity, then the financial statements prepared by a company will not provide a true and fair view of the financial position of the company. Say, for example, an expenditure of 5,000 rupees shall be recorded for 5,000 rupees only. It shall not be recorded for 10,000 or it shall not be recorded for 2,000 also. Neither less nor more than what is actually incurred. On the other hand, an income of 1 lakh rupees shall be recorded for 1 lakh rupees only, but not more or less than that. So, objectivity aims at providing an impartial approach while recording the transaction and without having any influence on the persons who are preparing the accounts. We know it very well that accountants and accounting staff in the company who are involved in preparing the accounts rely on evidences for regarding the financial transactions. Objectivity principle reinforces the necessity for recording the transactions in a impartial and unbiased manner so that the accounts provide a true and fair view of the financial position of the company to the outside world. But this cannot be achieved unless there is some standard required or needed to be implemented while preparing the accounts. If there is accounting standard, then in order to follow the accounting standard, the accountants may not deviate from the standard procedure which is to be followed while preparing the accounts. Imagine a situation where there are no accounting standards. If there are no accounting standards, the situation will be totally different. Every person will write in his own way, in his own manner, as to what he feels is correct. In such a situation, it will be difficult to analyze, understand, and compare the financial position of the company. Hence, the need for accounting standards is felt in order to achieve objectivity in the books of accounts. Then one more need for accounting standards is provided by uniformity in rules and regulations that are followed. If the rules and regulations that are followed by different companies are different, then comparability will become difficult. Comparison of the company's results with that of other company or comparison of that company's result from one year to another year or year on year comparison will become difficult. If accounting standards are followed, then uniformity in rules and regulations followed by the company can be achieved. For that purpose, the need for accounting standards is felt. Going further, one more point that focuses on need for accounting standard is comparison of financial statements. Nowadays, a lot of people like investors, research agencies, research analysts do a lot of research for giving investment advice and business advice. In such a situation, comparison of financial statements of a company can be done only when the company adopts a consistent and standard approach while preparing the accounts. In the absence of standard or consistent approach, the financial statements of a company cannot be compared, or the financial statements of one company cannot be compared with the other company. Take, for example, in the absence of accounting standards, one company reports some profit, another company reports some other profit. Can we compare? No, it will be difficult. If both the companies follow the same set of accounting standards and report profit, in such a situation, comparison of financial statements will become easy and the decision can be taken. So, this is how the need for accounting standard arises. Now, let us see the objectives of accounting standards. Accounting standards aim at bringing uniformity and providing the true and fair view of the financial position of a company. If we look into a detailed method as to how we can get benefit from the accounting standards, we can see that the objectives of accounting standards are transparency, universally acceptable policies, reliability, quality reporting, and comparability. If we see the first point, transparency. Transparency means information provided by a company is more. All the relevant and material information is provided by the company. Information on relevant topics, information on material facts that are provided by the company will matter much for the decision makers. Information given by a company will become a basis for the purpose of making decisions. So, transparency is more when information is more. Transparency is less when information is less. So, accounting standards aim at bringing more transparency into the financial statements provided by a company. All material facts relevant to the company shall be reported as it is. There shall not be any changes or manipulations in the facts reported by the company to its stakeholders. Different users of financial statements or financial information will rely their decisions on the information given by the company. Hence, transparency is more important, and accounting standards aim at bringing transparency in the financial statements provided or in the accounts prepared by a company. One more objective of financial of accounting standards is universally acceptable policies. If we see the financial statements of a company, the company in the beginning itself will provide the different policies that have been adopted by the company in order to record the financial transactions in one particular financial year. If the policies adopted by one company differ with the another company, then comparison will become difficult. In this situation, accounting standards aim at bringing similarity or making the accounting policies adopted by the companies universally equal or acceptable. When policies adopted by the companies are same, then there is no issue either in the process of using the information for making decisions or for the purpose of making comparisons. Then one more objective that accounting standards have is reliability. Reliability can be considered as the trustworthiness of the financial statements by the financial statements provided by the company. When financial statements are reliable, investors and different stakeholders are happy. When financial statements lack reliability, then investors or the stakeholders are not happy. But can we imagine reliability in the financial statements prepared by all companies without accounting standards? It is difficult. Hence, the accounting standards aim at reinforcing or bringing the reliability in the financial statements provided by the company. When financial statements are reliable, or when the figures given in the financial statements are reliable, then all the stakeholders are satisfied and happy, and there is no issue. When the financial statements are not reliable, then it is a big problem. For that purpose, in order to bring reliability, accounting standards aim at providing guidance on various issues, providing guidance on various methods to be followed while preparing the financial statements. Then, one more objective of accounting standards is quality reporting. Quality reporting Quality reporting aims at providing all material and relevant information to the stakeholders. Accounting standards aim at providing quality reporting or quality information to the different stakeholders so that they can base their decisions on the financial statements provided every year. Can we imagine quality in the financial statements without accounting standards? It's difficult. In all situations, it may not be possible. So, for that purpose, accounting standards aim at bringing quality reporting for the benefit of the stakeholders. Then, one more objective of accounting standards is comparability. This is more important when we talk about from the point of view of international investors. An investor situated outside India, an investor situated outside one particular country may try to compare the financial statements provided by one company with the financial statements provided by another company. Then, after comparison, he can make his investment decision. Or for making the comparison of the company year on year, last year to present year, like this, he tries to make a decision and which will be helpful or which will be beneficial when there is some standard called accounting standard. So all these objectives stress on bringing transparency, universally acceptable policies, reliability, quality reporting, and comparability only with the help of accounting standards. Having known the objectives of accounting standards, now let us see the benefits of accounting standards. What type of benefits accrue from the implementation of accounting standards? There are a lot of benefits that come on implementation of accounting standards, but a few important benefits are to be discussed. The first and foremost benefit that derives from implementation of accounting standards is it removes confusion or ambiguity that is there before the adoption of accounting standards. If a company is treating one particular transaction in some manner, the same may not be the position in some other company. In order to ensure that all the companies, or say for example, both the companies aim at preparing the financial statements in the same way, or bringing the value of the financial transactions to the same value, it is important that there shall not be any confusion. There shall not be any ambiguity over the treatment and recording of that particular transaction. So, like this, there are many benefits that accrue from the implementation of accounting standards to various stakeholders. Say, for example, accountants, shareholders, auditors, etc. Let us look on the some common benefits that come on implementation of accounting standards. First and foremost benefit that come on implementation of accounting standards is harmonization of accounting practices. The different accounting practices that are being followed for recording the financial transactions or preparation of financial accounts by one particular company will be harmonized, will be made similar. So prior to implementation of accounting standards, harmonization is difficult. But with the implementation of accounting standards, harmonization process will become very easy. So all the information provided by the companies shall be comparable. It will be easy to understand. It will be comparable year on year, or it will be comparable from one company to another company. So like this, harmonization can be achieved only with the help of accounting standards. Take for example International Financial Reporting Standards. International Financial Reporting Standards are a set of accounting standards which aim at harmonizing the accounting standards across the globe. As on today, more than 100 countries are following the International Financial Reporting Standards. In the era of globalization and the process of global capital mobilization across the world, an investor situated in one country can have car can put his investment in some other company which is not in his own country. In such a case, common accounting standards are required because without common accounting standards, the investor cannot follow his uh, company's financial statements wherein he has invested. Hence, the accounting standards aim at bringing harmonization in the accounting practices. Then, one more benefit that comes from accounting standards is disclosure of accounting policies. The accounting policies adopted by one company shall be disclosed as per the norms laid down by the accounting standards. As to how different values have been arrived, as to how the financial statements have been recorded, as to how the financial transactions are uh, documented in the financial statements will be disclosed. Then, one more benefit that comes from implementation of accounting standards is comparability of financial statements. When the accounting standards followed by two companies or more than two companies are same, then comparability of financial statements is possible. Comparability of financial statements will provide a basis for taking informed and important decisions by the companies, or informed and important decisions by the various stakeholders like investors, like creditors, like bankers, etc. When there is comparability, then analysis of performance of the company can be made. Otherwise, performance analysis cannot be made. Then one more benefit that comes from implementation of accounting standards is investor confidence. Investor is a person who has invested his hard earned money in an investment avenue in anticipation of some positive return in future. When one person commits his funds, when one person commits his money in one particular company, naturally he expects some earning or return on the investment. In such a case, if the financial statements does not provide a true and fair view, if the financial statements does not uh, contain reliability, if the financial statement does not provide a materialistic or unbiased view, then investor confidence will be very low. Investor confidence will be high when the value of the financial statements is more and the financial statements provided by the company carry high quality. In such a case, more information is expected by the investors. More information to be given by the companies can be stressed or can be implemented only by the accounting standards. Then one more benefit that comes from implementation of accounting standards is economic development. With the implementation of accounting standards, we can expect economic development also. For example, when a company provides financial statements in a true and fair manner, the investor's confidence will be high, comparability of the financial statements will be more, and with the true and fair approach of the financial statements, economic development is also possible. So, likewise, there are many benefits from the implementation of accounting standards. Having known the benefits of accounting standards, let us move to limitations part of the accounting standards. It is important to know the limitations that may come or the difficulties that may be faced in the process of implementation of accounting standards by a company. As all of us know that business environment of one country will be different with the business environment of some other country, and accounting standards are a set of rules and regulations or guiding principles for the preparation of accounts for the preparation of financial statements. So, in this situation, it is important to know that there are certain situations, or there may be some situation in which the accounting standard implementation may become difficult. The first and foremost limitation that may come in the process of implementation of financial accounting standards is rigidity, or rigid in nature of accounting standards. In some situations, the different traditions, the different practices, or the different systems that are in implementation in that particular country may become difficult, or may face a problem in implementing the accounting standards. Not all times, but in some situations or at some time, it may be difficult to implement the accounting standards. Then, one more limitation for implementation of accounting standards is differences in business environment. As discussed earlier, also, the business environment of one country may not be the same with that of business environment in some other country. The traditions, the practices, or the situations of one economy may not be the same in case of some other economy. In such a situation, applicability of some accounting standard, or applicability of few accounting standards, may not be so easy, or may not be so permitting that we are implementing the accounting standards easily. So, in such a case, all the differences that exist in the business environment of that particular place or of that particular country have to be studied, and a proper mechanism or a suitable strategy has to be devised in order to overcome the limitation on account of existing business environment in that particular country. Then, one more limitation that may come in the process of implementation of accounting standards is existence of local laws. Local laws or statutes prevail in one particular place or in one particular country, and accounting standards implementation shall not have any uh, disturbance, or shall not go beyond the existing local laws. So, in one point, it can be understood that accounting standards cannot be above the local law, or accounting standards cannot go above the law of the land, because when there is a situation where accounting standard and law of the land uh, are different, law of the land will prevail. Law of the land or the statutes are final. In such a situation, in such a circumstance, accounting standards cannot be implemented. Hence, it is important to note the law of the land, and the standards have to be prepared within the purview, or within the limitations, or within the sphere of the existing law of the land. Then only implementation of the accounting standards is possible. Otherwise, the implementation of accounting standards will not be possible. Hence, there are many limitations uh, in the process of implementation of accounting standards, and naturally, differences will exist sometimes in the process of treatment of various transactions while recording in the books of accounts. due to existence of some traditions, existence of some policies, etc. However, it is important to note that accounting standards aim at bringing uniformity in the financial statements and harmonization in the practices and providing true and fair view to the different stakeholders. Thank you.